Director. Hi, everyone. I'm Nicole Ombi, the Director of Member Experience Engagement. Welcome to our second and final workshop on the Employee Retention Tax Credit. For those of you that are not familiar with BECMA, BECMA stands for the Black Economic Council of Massachusetts. We were formed in 2015 by several Black business leaders, and our mission is to advance the economic well-being of Blacks across the Commonwealth. This workshop series will end up serving dozens of Black-owned business leaders across the Commonwealth, and so we're excited to share this information with you. Tonight, we're also very happy to feature Stone & Company. They're Massachusetts' largest Black-owned accounting firm. But before I begin tonight's presentation and hand over to Stone & Company, just a little housekeeping. There will be time for question and answers at the end, so please feel free to enter your questions into the chat at any time. Also, please let BECMA know if you have any concerns about being able to pay for the accounting fees that are associated with taking advantage of this tax credit opportunity. Without further ado, I'd like to introduce the team at Stone & Company.
Thanks, Nicole. Good evening, everyone. Definitely happy to be part of the discussion here this evening. And before we get started, I just wanted to mention, I'll introduce us in a second, but the approach we're going to take here is to really cover quite a bit of material in a short amount of time. So there's a lot of information in the slides, and the approach we're taking is, we wanted to just make sure we leave you some good reference material. We've asked the BECMA team to make sure that the slides and the information is available to all the participants, anybody who needs it. And, we think it'll be a nice reference material. So there is a lot here. We're not necessarily going to read through every slide, but we're going to touch on what we think is most relevant in terms of, this ERTC. So I'm going to go ahead and share my screen here. And just give me just a second here. Okay. So today we're talking about what I think is really an exciting credit that's available to small business owners. And, if you qualify this credit, once we walk through this, you'll see that this is definitely something you want to take advantage of. So in terms of the agenda itself and what we're going to talk about, we will try to cover, we'll introduce ourselves and we'll talk about the credit, try to define what that is. We'll talk about who qualifies. We'll go through the rules in general. There's some new rules that just came out a couple of months back, and so we'll want to make sure we bring some clarity to that. And we'll talk through some of the key terms that get thrown around so you can have some familiarity there. We'll take you through calculating the ERC the ERTC at a high level, just so you understand exactly what this calculation is and what it's doing for you in terms of how we're coming up with this credit. Again, high level, and maybe just touch on a couple of examples. And then we'll talk about the process itself. What's involved? What's the process here to claim this credit? What's the approach? How do we approach this thing? What do you need to provide? And, maybe we'll close this thing off with some key takeaways and get into some of these frequently asked questions from time to time. So in terms of the team itself, as Nicole mentioned, we are Stone & Company. We are the largest minority-owned CPA firm in Massachusetts. And, we're proud to share that with anyone we can, and we try to deliver as much value as we can. We're based out of Lexington, but we cover all of Greater Boston and beyond. And happy to support small business owners and nonprofits throughout the region and on any level that we can. So the team here today on this discussion are really three people from the team here at Stone. There's myself, I'm the managing partner here at Stone. I oversee all the financial statement audits, reviews, compilations, and any kind of financial reporting. And then my two colleagues here are the two people who head up the tax practice. Don Zidek is a tax partner, and he's ultimately in charge of the tax practice here at Stone. And we handle all, small business, nonprofits, and really any kind of tax advisory services. And then Caroline Waweru is a senior tax manager here at the firm, and she also operates in the same space. At the bottom here is Kevin Kozo, and Kevin is one of our partners. He's at Assure, and we partner with Assure. We'll talk about that later in the presentation, because they provide payroll services, and they're who actually processes the forms to get the appropriate forms filed and claim the credit while we do the analysis. And we'll clarify how that all works in a minute as we go through the slides. So, all right. So, I'm going to try to keep an eye on the time here to make sure we leave enough time at the end. But in terms of the ERTC and, what it is. All right. So this is an original provision from the CARES Act, and we got that in early 2020. It is a really good program, and it really, we got some new rules on top of the original CARES Act. Recently, we got the American Rescue Plan, which is, the third of the three major pieces of legislation that we got. We got that on March 11th this year, and that really extends and expands the ERTC, and we're going to explain, how that happened and, how good that is for small businesses. It's basically a refundable credit against the employer portion of Social Security, or Social Security tax. And it's, and when we say credit, I want to emphasize that, because a credit's much better than a deduction. That's, dollars back into your pocket, dollar for dollar credits, based on how much credit you qualify for. And you get that right back. In some cases, government even sends you a check. We'll talk about that as well, because there are different ways to file for this credit. So this is definitely a good thing. Now, this slide kind of summarizes who qualifies for the credit. Essentially, it is anyone who's in a trade or business. If you have W-2 employees, that's really what it comes down to. You've got W-2 employees, you qualified for the credit. It's not for the self-employed. It really, they make it a point in the legislation here to make it clear that it's not for household employees, right? If you have somebody you employ, like somebody to help you around the house or in the yard or whatever, it doesn't matter if they're an employee or not. You can't claim credit for those types of employees. And it absolutely applies to nonprofits. That's come up a lot. This credit is available to small businesses and nonprofits, if we have any nonprofit folks out there in the audience. Basically, you're going to fall into one of two groups to claim this credit. You're either going to have a business that was fully or partially shut down because of a government order. We'll talk about that as well. Or you're going to have a significant decline in gross receipts. And they define that, how much decline you have to have and how you calculate that. So it's either going to be one or the other in terms of the group that you fall in if you qualify for this credit. Now, just a little bit of history here. So, we talked about, what happened once this pandemic hit. We had the CARES Act. That was in March 2020, over a year ago. And that gave us this credit. That's how we initially got the credit. But it was somewhat limited back then. You could get up to $10,000 per employee of credit, but that was annually. That was capped at $10,000 for the year. And, for wages that you paid during 2020. And back then, if you applied for a PPP loan, you couldn't claim the credit. That was just what the rules were back then under the CARES Act. But then at the end of this past year, on December 27th, we got the Consolidations Appropriation Act, or the Consolidated Appropriations Act. And that was important legislation, because what it did was it allowed people who got a PPP loan to qualify for the credit. And it also upped the 50% limit that was previously in place to 70%. And on top of that, they removed the $10,000 cap per quarter and made that now $10,000 per quarter. Or before it was per year annually. Now they made it per quarter, so it's now $40,000 worth of wages per quarter, and that's a big deal. So and 70% of $40,000 is $28,000 for 2021. That's what we got from the Consolidated Appropriations Act. And then 3 months later, in March this year, we got the American Rescue Plan under the new administration, and that expanded this credit even further. It moved the period from June 30th, 2021, all the way out to the end of this year. So the credit now goes out to December 31st. And it also brought in startup business, because before, if you weren't in business by February 15, 2020, you couldn't claim this credit. Well, the American Rescue Plan removed that, and so new businesses now qualified. And it brought in some other features that really expanded the credit. So it's much easier to get, and it's much more lucrative for 2021. So that's just a little bit of history there with the legislation. Some key takeaways here, just to stop and make some points here. The rules in 2020 are different. They're quite limited, but in 2021, they're much more expanded. So that's an important thing to kind of remember. You can get a retroactive credit even if you got a PPP loan during 2020. So that's also very important, or any PPP loan that you got. Again, we mentioned the rules are different in 2021. And also, as we mentioned, the American Rescue Plan extends the ERTC through the end of this year. So it went from June 30th to 2021. I won't read through all of this, but again, we wanted to leave you this information as reference, because we asked the Beckman team to make these slides available. So yes, this just really sums up some of what the new rules are, which is that new businesses can qualify. So if you started your business after February 15, 2020, you potentially could qualify for this credit. And the other point here worth noting is that they brought in a new rule for what they call SFDRs, or severely financially distressed businesses. And this is if you had a 90% drop in income in any quarter. If you're in that category, you just automatically, certain rules apply to you and you can qualify for the credit. Outside of these two special areas here, you're really under the basic rules. And as we mentioned, you're going to fall into one of two buckets. If you're not one of these severely financially distressed employers, you are going to be in the group that had a significant decline in gross receipts. And, there's some rules to calculate that. Or the business was fully or partially shut down due to a government order. In basically the general rules are that if in any quarter during 2021, the new rules, you had a decline of 20% or more versus that same quarter in 2019, then the qualified wages paid in this current 2021 quarter are considered eligible up to $10,000 per quarter. That's a high-level summary of the essence of this new ERTC. New rules say you can get up to 10 grand per quarter if you had a significant decline in 20% or more versus the same quarter in 2019. And the only caveat here is that if you got a PPP loan, you have to exclude those from any wages. You can't claim those wages that were under the covered period of the PPP loan as qualified wages for the ERTC credit. Again, we mentioned the rules in 2020 are different. They're much more limited and the credit's smaller. Just some terms here that tend to come up from time to time. We talk about a significant decline in gross receipts. People ask that sometimes. And so it's important to just clarify what gross receipts mean. It's not just the stuff you sell to customers, the fees or what you charge to your customers. Gross receipts also includes, in addition to your total sales receipts, it includes interest, dividends, rents, royalties, annuities, and for nonprofits, any contributions, any gifts, grants, member dues, all that stuff counts as gross receipts. So that's important to remember. The other thing with this rule is, although any decline that you might have had is related to COVID, you're not required to prove that it was COVID related under this under the ERTC rules. So, again, even if you didn't qualify, you based on gross receipts, there's this other bucket that you might still qualify. Your income didn't drop in any particular quarter, but if you were forced to shut down or partially shut down because of some kind of a government order, you may still qualify. So yeah, just some important things there to remember regarding the ERTC. And then this term government order often causes some confusion with small businesses as well. And so it's important to just, take a second and just clarify what that might mean. So here are some examples. If you had an order from, your business had an order from the city mayor requiring that all non-essential businesses had to close, that would be, that would qualify. The state, there's some kind of emergency proclamation that residents have to shelter in place, and a few others here. At a local curfew, some health department, government agency, they mandated some sort of workplace closure. Just for COVID, you had to clean and disinfect. That stuff qualifies. The main theme here, we just picked some random examples, but the main theme here is that the business owner just didn't have a choice. It was because of some government order. Just some other examples here, full or partial shutdowns, just to kind of clarify a little bit. Again, we're not going to spend too much time on this, but just some examples here. There's some judgment involved, so you want to make sure you're talking to somebody who's familiar with this thing, because if you were shut down and your business was clearly closed, but you're in the type of business where you could telework or telecommute or work remotely, that's not a full or partial shutdown because you continue to operate there. So there are some nuances there, but we won't spend too much time there because there is a lot of judgment, and each set of circumstances, is going to involve some analysis and some documentation. The key takeaway here that you want to keep good records. If you're in this bucket where you're going to try to qualify based on a government shutdown, you want to keep good documentation of when the government order was issued and when it ended, because you're really limited to the wages paid during that shutdown period. So you want to make sure you have good records there. This is another item that I think is worth clarifying. So what are large employers versus small employers? This comes up quite a bit, but it's really generally not an issue for the types of clients that we service and maybe many other people here. The new legislation that we got in March moved the threshold from 100 all the way up to 500 employees. And so anything under 500 is a small employer, and that matters because large employers can only claim the credit for wages that were paid to employees who are not working, whereas small employers, your qualified wages can be wages paid to all employees, whether they were working or not. So there is a distinction there. Generally not an issue for a lot of the business in our space because we don't have 500 employees, but it does come up. And we like this slide here because it's really a good slide here, slide 13. It's a nice one to just kind of really soak in because it sums up the entire act and it really compares the differences from 2020 to 2021. In terms of the calculation itself, it's really kind of two pieces. You're going to figure out which are the qualifying quarters. We're going to show you how to do that in a few minutes here. And then you're going to compare the quarters in 2021, if we're talking 2021, versus the corresponding quarter in 2019. 2019 is a base year. If you're doing 2020, you're going to compare that quarter in 2020 to 2019. 2019 is generally the base year. So for 2021, we're talking a 20% drop. 2020, back then, it was a 50% drop, which is a pretty high threshold. So as you look at the comparison here, just to kind of quickly walk through them, The original legislation only took the credit through December 31st, 20. The new rules takes it all the way through the end of this year, so you can claim on wages paid all the way through the end of 2021. The second line here is a big deal. $10,000 annually was a cap. Now it's $10,000 quarterly, so much more favorable for small business owners. Even the credit itself used to be 50% of wages, only 50%. Now they moved it to 70%. Again, much more favorable. We talked about the employee threshold. It's all the way up to 500 for large versus small employer. And then the gross receipts is also more favorable, because before you had, for 2020, you had to have a 50% reduction. But when you get to 2021, you only need a 20% reduction versus 2019. Of course, the maximum credit on the 2020s, because it was a $10,000 cap with 50%, maximum credit would be $5,000. 2021, very, very different. The maximum credit is 70%, or 70% of $10,000 per quarter, $7,000 per quarter, or $28,000 annually. So much, much more favorable for 2021. So this is a good slide. The other thing to mention here, the font here in red, very, very important. The quarter after a qualifying quarter, the way the rules are written, that also becomes a qualifying quarter, just the way they wrote the rules. So if you have a drop that meet the criteria here, the quarter after that also qualifies. So very important. All right, so these slides here essentially just wanted to give you a picture of how the credit works. So there's two phases. You're going to figure out the qualifying quarters, and then you're going to calculate your credit based on what you paid to your employees. So we're in this first part of figuring out your credit here. So this particular employer has, they're looking at their quarters, and they're looking at how much in 2019 they're the 4 quarters, and then in 2020 they're the 4 quarters. For 2020, you're always comparing to 2019, just like 2021 when you get there. So we're comparing to 2019, and we see that Q1 we had a 20% drop, 33%. It's 2020, it's a 50% threshold, so we still don't have a qualifying quarter. When we get down to the third line, Q3, all of a sudden the drop in revenues is more than 50%, so that's a qualifying quarter. It's 53% over here. And so the quarter after that, even though it didn't drop by 50%, that also becomes a qualifying quarter. So for 2020, this business has 2 qualifying quarters. We go to 2021, and we're comparing to 2019 again, and we're comparing 2021 to whatever it was in 2019. And we see that we had a 20% drop, a 20% increase here, 25% drop, a 33% drop, it's 33% increase, and then we increased again 8.3%. So in the second quarter, that was the only quarter that we had a drop in revenues versus the same Q2 in 2019. So that becomes a qualifying quarter. But as we said, the quarter after that is also qualifying. The other difference here versus 2020, if I back up, we needed a 50% drop in 2020, but for 2021, you only need a 20% drop. So we automatically got Q2, and then we also get Q3 because it's a quarter after. So that's basically the exercise to calculate the qualifying quarters. This slide here just kind of sums it up. It's the same thing, just, the percentages are the other direction. Here we have 2 qualifying quarters because we dropped 60%. 2020 revenues was 40% of what you had for that quarter in 2019, so it dropped by 60%. This one dropped by 52%. So both of these quarters, because it's 2020, dropped by more than 50%. So they're both qualifying. The takeaway here is that not only is that quarter qualifying and that quarter qualifying, but the one after also qualifies. So your qualifying wages would end right at the end of the year because the quarter after also counts. And for 2021, since we only need a 20% drop, we have these 2 quarters that would qualify. I'm sorry, I did it backwards. So 2020, you would have, these 2 quarters. The qualifying period would end October uh, uh, October 1, 2020. So right here is where we'd have it. We had a 60% drop here, and because of that, the other quarter qualifies. So this slide here, is just looking at it from a different perspective. All right. So in terms of the calculation of your credit, you've identified the qualifying quarters, and you really want to figure out how much your credit is now. So, a few things before we try to figure that out. We got to remember you can't include any wages that you paid with PPP money. So that's important. So when we're doing the calculation, we'll want to know if you got a PPP loan or not, and get the information from that so we can properly figure out your credit, because you have to exclude that. Once you file for forgiveness, you're locked into those numbers, because if you use those wages as the wages you paid with PPP money when you sent in your application for forgiveness, you can't change that. The application's always in. So so that's an opportunity there if you, if you haven't applied for forgiveness yet. You can't double dip. You can't, claim wages that you already used to claim other credits. So just some things to remember there. The other thing to remember for calculating the credit here is full-time employees. Excuse me. So that's defined differently. It was the definition was complex for PPP. It's very simple for ERTC. All they're saying is if during 2019 you have an employee that worked at least 30 hours per week or 130 hours per month, that's a full-time employee. That's how they wrote the definition for this particular credit. So different, because for PPP we had this complex calculation we had to go through. This one's fairly straightforward. So and it's always based on 2019 for the base year. They have some rules for those businesses that started after that weren't in business during 2019. So some special rules for that. So in terms of the calculating the credit, you're really just going to list all your employees. Remember, for 2020, it's capped at $10,000, so maximum credit's $5,000. And then for 2021, much better, $10,000 per quarter, 70% instead of 50%. And then so your maximum credit is $28,000 for 2021. So to calculate the credit for some employees, we just thought, and just to give you a visual here of what that might look like. This particular business has 2 employees. So, they want to figure out what their credit is. They've already figured out that they have 2 qualifying quarters, Q3 and Q4, and they're doing it for 2020. Remember, for 2020, you need a 50% drop in revenues. And so we have the amounts paid here to the employees down here in the shaded area, 2 employees. For the first one, we paid that employee $8,000 in Q3 and another $8,000 in Q4. But since 2020 is capped at $10,000 for the whole year, the only wages we can take the credit we can use to calculate the credit is $10,000, even though we paid them $8,000 plus 8. So it's $10,000 is what we can use, and so 50% of that, that's the rule for 2020, would be $5,000. So that's the maximum credit for that employee. And then for employee 2, we paid that person $5,000 in that qualifying quarter, Q3, and then another $5,000 in Q4 over here. And so the total is $10,000, and that's what the cap is. We're right up against the cap. So we, if we even paid them $1 more, we couldn't claim that as wages used to calculate the credit. So for this business, they had 2 employees, $5,000 and $5,000 of credit. Total credit for this particular year for 2020 for this business is $10,000. So they get a $10,000 credit. Now the same business moves to 2021, and they've got, for 2021, they had 2 different qualifying quarters. For 2021, they had Q2 and Q3 as the qualifying quarters. So they paid employee number 1 $8,000, excuse me, in Q2, and $10,000 in Q3. So the total that they paid to employee 1 is $18,000. And they can use that for qualifying wages, because if you remember, There's no cap for 2021. There's no $10,000 annual cap. It's 10,000 per quarter. And they clearly met that here, so they can get all $18,000 and use that to calculate the credit. For the second employee, they paid $6,000 in Q2. That's a qualifying quarter, and then $7,000 in Q3. So in total, they paid the second employee $13,000, and so they can use that to qualify as qualifying wages. And remember, for 2021, it's not 50%, but 70%. So 70% of 18,000 is 12,600, and 70% of 13,000 is 9,100. So the total credit that they are getting there, if I can do my math here, is $21,700. Remember, I'm going to page back here. They got $10,000 for 2020, and then $21,700 for 2021. This is a business with 2 employees. So just to sum it up here, 2020, we got a $10,000 credit. 2021, $21,700. So this is a business with 2 employees. And for ERTC credits, they ended up with $31,700 in credits that come right back to them. So, this just really drives home the point that if you qualify this credit, if you qualify for the credit, you want to get the credit. And this slide just really sums it up. We're talking big dollars here for this credit, for businesses that qualify. So if you can get it, you definitely want this credit. All right. So how do we go about getting the credit itself? So you're going to claim the credit in several different ways, right? For 2020, you've already your payroll companies already filed your 941, your Form 941s. That's your payroll tax forms that you file each quarter. So you're going to have to amend those to get the credit. So for your 2020, the way you're going to get that credit is the payroll company is going to file some 941Xs for you. That's the amendment to the 941 that's already filed. So that's how you get that credit. But for 2021, you got some options. There's different ways to get this credit. You can claim it as you go along, as you're filing your 941s throughout 2021. Or you can file what's called IRS Form 7200, which is a form where you actually calculate and estimate the credit, and then you just claim it, and they'll send you a check. The IRS will actually pay you ahead of time for the credit that you calculated and estimated, and you get that cash up front. Or you can just not do it at all and take it later, just like you do your regular taxes, and get a refund of the credit that you're due. So different ways to claim the credit, but wanted to throw that up there to give people an awareness of how that might work. In terms of the process itself, for most of us, the payroll company is going to file your 941s, as we mentioned. That kind of happens behind the scenes automatically for most businesses. Some businesses, the arrangement's a little different, and somebody else might be doing it for them outside of payroll. They may do their own payroll. Somebody else files a form, but generally that's how that's going to work. But the one of the messages here, though, is that payroll companies, generally speaking, they're just going to file whatever information you give them. Just like payroll, you give them certain hours, hours work for employees. That's what they process, and they pay them. Same thing with the ERTC. You're just going to tell them what your credit is or what to do, and they'll file the forms. And they always file the forms properly, but it's based on information you give them, generally speaking. So what's important is that analysis to really evaluate whether or not you qualify for the credit, and the calculation to see how much the credit is. So that's kind of important, that step, because the payroll company is just going to take that and file it and, you get your credit. But that first piece is important, that analysis to see if you qualify, what you qualify for, and how that's calculated. So that's really critical, and you want to have that documented and packaged, to support whatever claim you have, because, obviously it's the IRS, they can audit anything they want. Now, what's interesting with this rule, the ERTC, is that, generally speaking, IRS rules are 3 years. Well, for this, under this act, they gave themselves 5 years from the date you file to audit any credits, any ERTCs that you claim. And so you want to make sure you have the right documentation in place and you keep that safely on file. In case well, how did I come up with these numbers? You want to have that documentation in place. So that's kind of important. And so this is where your accountant or somebody like us might come in. Basically, the services, I have to describe it. There's two pieces, right? There's a analysis, and what do you qualify for? What does that credit look like? How do we calculate it? All that stuff, and figuring out your credit. That's kind of the first phase. And then the second piece is the actual filing of the forms to claim the credit. We're in the first phase. That's what we do as an accounting firm, and every accounting firm is different. They specialize in different things. We are the traditional accounting firm, so we do analyses, accounting, financial statements, tax of every type. We don't do payroll though, so we're not a payroll company. We don't file payroll forms or all that. We do all the tax returns, but not the payroll tax forms. So we do the analysis to help you figure out the credit, calculate it, and have your package together. But in terms of the actual filing, that's going to be done by a payroll company, and once they have your information. And if your payroll company doesn't do that, some payroll companies offer that service separately to do the analysis for you and calculate the credit, but that's not traditionally what all payroll companies do. They do payroll, but there are a few specialty payroll companies and other companies that'll actually do the analysis, just like we would do for you. So if your payroll company doesn't do it, you need to engage a specialist to help you figure out your credit and make the right judgments and do the analysis. So, and this is what I was saying, we do the advisory services to help you determine whether or not you qualify for the credit and help you calculate it. The actual preparation would be done by somebody like our partner. We partner with a firm who does that. It's Assure, and their contact information is here in the slide. You want to call a fellow named Kevin, and he's going to guide you to where you need to be. But you're basically going to take that information and then use your payroll company or a similar company to get your 941s or however you're claiming them, get those forms filed. So that's the general approach there. And the process itself, we wanted to make sure we bring some clarity to that. It's basically as we have it here. You contact us, you engage us. We'll give you a basic list of items that we need, and we'll give you a private folder within our portal, which is secure. We don't like to attach documents to email. We strongly discourage all our clients from attaching things to email, especially when it comes to taxes and payroll and all that sensitive information. You get a private folder in a secure portal. It takes us seconds to create that, and you have your own password. You upload the information we ask you for. We do the analysis. We're going to ask you for your quarterly revenue, revenue by quarter. We're going to ask you for some basic information, and then we'll prepare the analysis for you, and then you have what you need to then work with Assure or your payroll provider or whoever is going to get your payroll forms file and claim the credit. So that's what the process looks like at a high level. What do you need to get started? What are we going to ask you for? We're going to ask you for your quarterly revenues, your payroll information by employee, as we saw in those examples, your PPP loan information, including some of the information we have written up here. And then we ask you to be available if we have follow-up questions or we want to clarify things to help get the thing done efficiently. I wanted to move us along so I could get to this slide, and we're doing great on time. So I want to spend some time because, as we try to finalize a date for the presentation, I was happy to realize that it was going to be on a date when two of my firm's tax experts were available. So I asked them to join us, and those are the people that I introduced you to in the beginning. I've got Don Zidek, tax partner here. I've got Caroline here, senior tax manager here at the firm. And what I did here was I tried to really gather as much questions from clients and people talking about this stuff, and tried to gather the frequently asked questions because I thought that would be valuable to the people in this discussion, just to see if we can get more clarity regarding these areas. So with that said, let's see if we can take just a few minutes and just, go through these things and see, see if we can clarify them a little bit. So let me start. I'll start at the top here, Caroline and Don. So this first one here this comes up fairly often. Can I still claim the credit if I took out a PPP loan?
Yes. So good evening, everybody. So the answer to that is yes, you can. But as Rob had mentioned in an earlier slide, you cannot double dip. So any qualified wages that were used for PPP loan forgiveness cannot be used for the ERTC. It's also worth mentioning too, as a planning suggestion, that if you're taking out a second PPP loan and you haven't filed the forgiveness application yet, it would be a good idea to hold off until you see, how this interplays with the ERTC, because you don't want to use too much payroll on the forgiveness application if some of that could be used for the ERTC credit.
Right. No, that's a good point, Don, because there's a little bit an opportunity here for some strategy to really maximize your credit. I've seen a lot of people claiming more wages just to make sure it's clear they get all their PPP forgiven. So they claim more than they need to, and so they can't claim those wages anymore for any other credit, or like the RTC. So yeah, it makes a lot of sense. How about this next one here, guys? So we get this as well. What's the cost of services? That one I think I know, because I know that the answer is that it depends, right? It depends on who you're dealing with. Everybody's got a different model. Some people charge by the employee. Some people charge by a percentage of the credit that you get. We know we charge for our services. Do I have that right, guys? Or
Yeah, you got that.
Yeah. So I'm just gonna skip that one and move on to some of the other ones that come in here. It really depends, that second bullet. How about this one here? How is the ERTC processed?
So, hi, everybody. So, as Rob mentioned in the presentation, this is really a two-part process. So there's the process of determining if you're eligible and what wages would be eligible for the credit. And then once we determine your eligibility and what qualifies and what quotas should be filed for, then the payroll company or the specialist would help file the necessary forms, either the amendment for the payroll forms or Form 7200 that would help you claim the credit currently as you run your payroll.
All right. Thanks, Caroline. All right. I'm going to skip these other two bullets. They're, kind of technical and they could take us off on a tangent. How about this one here? Can sole proprietorships claim the ERTC?
Yeah. So the answer to that is yes. The sole proprietor can claim the ERTC, but only if they have employees.
Right. So you got to have W-2 employees.
That is correct.
Yeah. Okay. So the answer is yes. If you have this other one here, this comes up quite a bit. It's kind of a little bit vague sometimes, but people ask, can owners count their earnings as qualified wages for the ERTC?
Absolutely. So if you're the owner and you're paying yourself W-2 wages and your spouse as well is getting W-2 wages, you both do qualify to be included in the calculation for the credit.
All right, good. And this, Caroline, this looks like it ties into that next question that we get sometimes. What about wages paid to family members? Can you share anything about that?
So unfortunately with that one, if you have family members who work with you or who work for you and they get W-2 wages, they would not qualify to be included in the calculation for the credit. So your cousins, your parents, your children, they do not qualify to be included in the wage base for the calculation. Just your spouse and yourself.
And there are probably some rules specifically regarding those. All right, thanks, Caroline. All right, let's see. So we get some more here. Just try to gather what people are asking, just to share them with everyone. what if a company, oh yeah, this comes up quite a bit. We might have touched on this before too. What if a company was not in business during 2019, this base year that they keep talking about?
So the answer to that is, so what happens is the 2019 tax year is used as the look back period to see if you're eligible based upon the gross receipts method. But if you weren't in business in 2019, then the 2020 tax year is used as the comparison year.
All right, and we got that with the new rules there, which made it more favorable. All right, thanks, Don.
Sure.
All right, so this one here has to do with employee count. I'm not 100% sure what they were getting at, the people who are asking this, but what employee count determines eligibility for the ERTC? If one of you guys can help us with that.
So the good news with this is that there's no limit on how many employees you need to have in order to qualify for the credit. So as long as you have W-2 employees, you can qualify for the credit, provided you meet all the other criteria. So there's no minimum or maximum employee requirement for you to qualify for the credit.
So wait a minute, Caroline, you're telling me if I have a business and I have one W-2 employee, I can still get the credit?
Yes, as long as you meet the other criteria.
Right. Okay. That's important because it's come up quite a bit.
Yep.
I think we've had at least some people asking, I only have 3, the other direction. I only have 3. Can I still apply? Kind of, like that. But on the other end, there's no, there's no threshold that you have to be over to claim the credit either. So more than one, it counts.
Mm-hmm.
And this one here, this was really, I think this came from people who know that we partner with Assure. They're asking if the Assure software will determine a client's eligibility for the ERTC. Can I throw that out there? I might know the answer to this one, but you guys have any thoughts on this one, or should I give it a crack? I think I know the answer. All right.
I'll go for it. So like we said, that there's a 2-part process to claiming the credit, and part of that is determining if you qualify for the credit. That part, Assure would not be doing that part. We would be helping you figure that out, whether you qualify for the credit. And then if using Assure would be actually filing the forms for you and finishing the process if you were to use Assure.
All right. Yeah, that's exactly what I was going to say.
Mm-hmm.
But you'll summarize it a lot better than me. All right. So these are some of the more common questions that tend to come up. Hopefully this was helpful in terms of these. We want to capture the ones that are most common. And, and I think we're doing fine on time here because I think we can kind of bring this in now. So some key takeaways from what we just shared with you is that this credit's a big deal. It's big money, relatively speaking, and depending on whether you're a small or large employer. Their government's really going out of their way here to support businesses and put dollars back in our pockets. The other takeaway here is that rules for 21 are different because everybody got used to the 2020 rules for an entire year, all the way up through 2020 and the end of December. And, everybody, PPP loan, they just don't bother with the credit because we all knew we couldn't apply for that credit. Took out a PPP loan. Well, the rules are different for 2021, and that's a lot more favorable. The other takeaway here is this PPP loan, as we just mentioned. If you took out a PPP loan, don't disregard this credit. You may still qualify for it. And then finally, we say that in our business all the time: documentation. Mm-hmm. You got to document everything you do and keep that documentation. It's the IRS. We don't know what they'll do, or we can't predict. And sometimes they say they're on the resources, then they're auditing somebody they, probably shouldn't be auditing. But We don't know. It's the IRS. So you want to make sure you document and keep that stuff on file. And then I could stop there. Before I close down, I don't know if let me just back up here and just turn it over to Don or Caroline just to see if you had any general thoughts you wanted to add.
Yes, I do have one thing to add, and that is if you take the ERTC credit, it also affects the deductions you can take on your tax return. So whether or not you file a corporate return or a partnership return or just a Schedule C off your individual return, if you claim the ERTC credit, you have to make an adjustment for the deduction you take for the payroll. So you can't double count the same wages on your business tax return or your Schedule C return. So that's something that you have to take into consideration. Now, if you haven't taken the ERTC yet for 2020, like you said, you can still claim that credit. But if you've already filed your tax return for 2020, you can go ahead and you can have your return amended to make that adjustment.
Mm-hmm. Yeah, that's an important comment there, I think, Don. I'm just not a big fan of leaving money on the table. So, we want to spread the word on this credit here. So, all right. So I'm going to see if I can bring us to
Robert. This is Nicole from BECMA. I wanted to just take a moment here, and I love the frequently asked questions because I think you addressed a lot of the questions, but wanted to just take a pause and see if anyone participating has any other questions. Otherwise we'll wrap up. Just wanted to give that space. And in the meantime, I wanted to be sure to thank the BECMA team for pulling together tonight's event. Thank Stone & Company for taking the time to pull together this really great presentation. Thank everyone for participating. We really hope that you're able to take advantage of this relief effort. And as you can see, there is the contact information for the Stone & Company team. You can get in contact with them about how to take advantage of this tax credit opportunity. And as we mentioned at the beginning of this workshop, if you have any concerns or any questions about being able to cover the cost of taking advantages of this opportunity, please get in touch with the BECMA team, which is at membership@becma.org. And we're happy to give assistance in that space. I actually have one question for the team. If you would indulge me. We talk a lot about throughout this presentation about the employee tax credit. Is it true that the tax credit is convertible to cash? So it's not just a credit, but you can actually get cash back.
That's 100% true, Nicole. You can file, and I like answering these because I have the tax experts with me to correct me if I'm wrong. You can file IRS Form 7200 and estimate the credit, and the government will send you a check based on the credits that you expect through the end of the year. And the answer is yes. You can actually get cash back. For your estimated credit. I don't know if Don or Caroline, if you wanted to add anything to that, to Nicole's question there.
Yeah, the one thing I would add too is since payroll returns are filed quarterly, the timing of getting the benefits of the credit is more immediate than, say, a traditional claiming a credit on a tax return. We have to wait a year to get that. But as Rob mentioned, you can file the Form 7200 to get the refund, which is a good way for cash flow purposes.
Mm-hmm. Great. So, Robert, team, any last words before we wrap?
I guess I just wanted to close by just saying thank you to yourself, Nicole, and the BECMA team. I just really, throughout the process, gained a really good appreciation for some of the good work that the BECMA team is doing. And, I thank all the business owners out there who decided to join us. Really, it always feels good to interact with small business owners. You feel free to reach out. The contact information is here. We asked the BECMA team to share the slides so you have the information, including how to reach us if you need us. We are, as I mentioned before, we love spreading this around. We are the largest minority-owned CPA firm in Massachusetts. Very proud of it, and we're happy to support businesses of all types. And just thank you for hosting us, and we're happy to contribute and support in any way that we can.
Mm-hmm. Fantastic. Thank you, everyone, and happy Juneteenth to all. Thanks again.
Thank you. Have a good night, everybody.
Yeah, thank you. Have a good night, everybody.
Bye.